In the glittering world of Wall Street, where stock tickers flash and trades happen in the blink of an eye, there exists a hidden layer of finance that most ordinary investors never see. These are the dark pools, private trading venues where billions of dollars worth of stocks change hands every day, away from the bright lights of the public exchanges. At first glance, the idea sounds like something out of a spy novel. Secret trading floors where the world's biggest players move money in silence. But dark pools are very real, and they have quietly become one of the most controversial features of modern finance. Born in the late 1980s, dark pools were originally designed to help big institutional investors like pension funds and mutual funds trade massive blocks of stock without tipping off the market. Imagine if a pension fund tried to sell $1 billion worth of Apple shares on the open market. The moment other traders saw it, prices would plunge. Dark pools offered a discreet way to carry out such trades, protecting long-term investors from sudden swings. Yet, as these hidden venues grew, so did the concerns. By 2024, dark pools account for nearly 40% of U.S. stock trading volume, according to data from the Securities and Exchange Commission. That means almost half of America's stock trades happen away from public exchanges like the New York Stock Exchange or NASDAQ. Critics argue this undermines transparency, making markets less fair for ordinary investors. If prices are being set in the shadows, how can we trust that they reflect true supply and demand? One of the biggest controversies has been the role of high-frequency traders, firms that use powerful algorithms to profit from microsecond advantages. Many have been accused of exploiting dark pools by detecting patterns in hidden trades and racing ahead of slower investors. This practice, known as latency arbitrage, sparked investigations by regulators and lawsuits against major banks. In fact, some of Wall Street's largest players, Goldman Sachs, Credit Suisse, Barclays, have faced fines for misleading clients about how their dark pools operated. Still, defenders of dark pools argue they are misunderstood. They say these platforms lower costs for large investors and provide much-needed liquidity to markets. Without them, public exchanges might be more volatile, with dramatic price swings every time a big fund decided to buy or sell. The debate over dark pools is ultimately about trust and fairness. Should finance prioritize efficiency for the giants who move billions, or transparency for the millions of everyday investors who rely on fair markets? Regulators continue to grapple with this tension, tightening rules to make these secretive venues more transparent, while the financial industry pushes back, insisting they are vital to modern trading. For the average person, dark pools may remain invisible, but their influence is undeniable. They are the quiet backrooms of global finance, shaping the prices in our retirement accounts, the stability of stock markets, and perhaps the very trust we place in the system itself.